Good morning, everyone, and welcome to the 2025 SEC Investor Advocacy Law School Clinic Summit. I'm Christina Martin Fervita. I am the Investor Advocate at the Securities and Exchange Commission, and the Office of the Investor Advocate is pleased to host today's event. Before we begin this excellent day of dialogue, I would like to offer a disclaimer regarding my own remarks and the remarks of all other speakers and moderators from the SEC today. Our remarks today are provided in our official capacity as the staff of the Commission, but do not necessarily reflect the views of the Commission, the commissioners, or other members of the staff. Having gotten that out of the way, I want to start the day by welcoming the students and the directors of the law school clinics from the following schools who are joining us today: Cardozo Law School, Cornell Law School, my alma mater, the Elizabeth Haub School of Law at Pace University, Fordham University Law School, Howard University Law School, Northwestern Pritzker School of Law, St. John's University School of Law, Seton Hall Law School, the University of Miami Law School, and last, the University of Pittsburgh Law School. The work that you do to assist investors who do not have other avenues for legal representation in arbitration is important and valuable. The origin story of the securities arbitration clinics is as relevant today as it was 28 years ago when the first two clinics at Fordham and Pace were launched. I'm sure all of you know that the establishment of the clinics, which was encouraged by then SEC Chairman Arthur Levitt, was a response to concerns that were raised by retail investors who had arbitration claims that were too small to justify legal fees. Without pro bono services, these retail investors would in many cases never adjudicate their claims. What was true then is still true today, and your clinics serve this critical need of these clients while at the same time providing, of course, all of the law students who participate with valuable practical experiences. Just as the SEC learned in the late 90s from retail investor complaints regarding their lack of access to representation and identified the creation of law school clinics as a solution to a real need, arbitration law school clinics as a solution to a real need, so too today we hope that we can learn from you about the retail investor experiences that may reveal to us real problems that merit our care and attention. You have in your work an opportunity to see firsthand and often first in time emerging challenges with financial services, products, and practices. You serve clients who typically do not communicate directly with us or with other regulators, if at all, about their concerns. And today, when we hear from you about your clients and the cases that you have with them, that will provide for us, for our office, and for the rest of the SEC staff listening in today, a very valuable window into experiences and challenges that may otherwise remain unseen by us. Now, in addition to welcoming you, the law students and clinic directors, I would also like to take a moment to thank the Honorable Jonathan Pittman, Associate Judge of the Superior Court of the District of Columbia, David Marchenkas, Counsel to the Chairman of the SEC, and Sarah Mishevitz, Senior Counsel to the United States Senate Committee on Health, Education, Labor, and Pensions. They will present a little later this morning, and we are looking forward to hearing from them about their individual career paths and their unique perspectives on serving the public through our three separate branches of government. We greatly appreciate the time they are taking from their busy schedules today to share their unique insights. Finally, I would also like to thank Chairman Ueda and Commissioners Peirce and Crenshaw for their participation today, and most importantly, for their support of the work that all of you perform through the clinics. With that, I would like to introduce Commissioner Hester Peirce, who has some remarks for us this morning.
Good morning and welcome to this year's Investor Advocacy Law Clinic Summit. Of the many wonderful programs and events that the Commission's Office of the Investor Advocate sponsors, this summit is uniquely consequential. Bringing together law students from 10 participating law school clinics affords an opportunity both to shape the next rank of attorneys as well as to provide us at the Commission the opportunity to hear from clinic participants presenting their experiences gathered from working directly with retail investors. Every day, new products and technologies change the way investors engage with the market, and keeping pace with the technological dynamism animating today's capital markets requires creativity and nimbleness. While improved technologies and access to information have facilitated the entry of a whole new generation of investors, you all see firsthand how these advances are also used to harm investors. The challenge for all of us as we try to anticipate and block financial criminals from preying on retail investors is that we do not inadvertently prevent those same investors from improving their lives through participation in our capital markets. Yes, social media can provide a platform for people providing bad financial advice or something even worse, but these same sites can just as easily be used by those sounding the alarm when something is amiss. When we contemplate the misuse of AI to facilitate fraud, we must not forget that AI also has made investment advice affordable to countless retail investors previously unable to access it. The same tools that enable people to craft a compelling pitch for a fraud enable an honest asset manager to communicate with investors in ways that are uniquely well suited to their needs. We do best by equipping investors early and often with sound, timeless lessons. While the mechanics of fraud may change, the remedies for investors remain the same. Know your risk tolerance, educate yourself, and maintain a healthy skepticism before you part with your money. I'm sorry that I can't be there with you in person, but I look forward to reviewing your presentations. Before I conclude, I want to thank Christina Martin for Avita, Adam Anasich, Lisa Skirzicki, and the other commission staff who made today's event possible. My thanks go as well to all of you who have dedicated yourselves to assisting investors in distress and in making your knowledge available to us. I hope that some of you will make helping investors your life's work. Thank you and enjoy the rest of the summit.
Well, thank you very much, Commissioner Peirce. We appreciate your support as always. Hello, everyone. Welcome to the SEC's 2025 Investor Advocacy Law School Clinic Summit. My name is Adam Anasich, and I serve as the Investor Engagement Manager here at the Commission, where we seek input from investors, both large and small. So think everybody from like your grandparents all the way up to the world's largest investors. And we really do that for a couple of reasons, but the ultimate goal is to better inform the SEC's positions and rulemakings. This really is an example of your government working for you. As Christina mentioned, we're thrilled to have you join us today, and we're looking forward to hearing your presentations. For our SEC colleagues who are joining us in various offices across the country, welcome and thank you for coming. This event is actually one in a series of public engagements and internal meetings that the Office of the Investor Advocate hosts around the country, with the intention of amplifying the voice of investors and ensuring that their interests are represented in SEC policy and practice. Today's event is notable for a few reasons. It allows us to hear from all 10 of the law clinics on issues important to their clients, all of which were derived independently by the schools. Number two, the summit brings together some of the best emerging minds in securities law into a single event, and we get to benefit from hearing those views. Three, hosting virtual events like this allows the SEC senior leaders to effectively and efficiently receive input from all of you without the burden of drafting a comment letter or traveling to Washington, D.C. to visit us in person here at the headquarters. So, as you listen today, I would ask a few things. First, think about the presentation topics and how they apply to your own work. How might you ensure that investor voices are included in what you do? Some administrative notes today is just keeping your microphones muted. It's really going to cut down on the background noise, turning off video unless you're speaking. We do have a chat function in the WebEx, and we've really allowed this to be open to everybody. So there is a chat box. If you have questions, please feel free to drop them in the chat. This is going to be a fast-paced event with a very specific time frame allotted for each school so that everybody has a chance to go with more than 30 student presenters from 10 different schools. We've got a number of really exciting commentary and presentations that you'll be able to listen to. So if you're a moderator, if you're one of the presenters, please do stick to your allotted time. Otherwise, other students will lose out on their time. Before I turn it over to Lisa for our first panel, I'd like to give special thanks to Christina. She was the one thanking everyone earlier, and really now it's our turn to thank her for her leadership and support of these sessions. As the investor advocate, she oversees all these types of engagement activities, and it's honestly a privilege and a pleasure to work for her. I also wanted to thank our divisions and offices here at the SEC, specifically the Small Business Capital Formation Office, because Stacy Bowers and her team over there, who you'll hear from later today, do just a phenomenal job helping raise awareness of the three-part mission of the SEC, both protecting investors, facilitating capital formation, and then maintaining fair and efficient, orderly markets. I wanted to thank Lisa and the Ombuds team for all their work directly helping retail investors. Andrew Sporkin for working to set up this event, Jackie Akia to work to set up this event, Pam Gibbs for her leadership. She recently retired, and we appreciate her years of service to the commission. Want to thank the clinic directors and the moderators for bringing all of our talented groups together, but most importantly, all of you, the presenters and the audience. We value the opportunity to learn from each other and share in this constructive dialogue. So now, without further ado, let me welcome Lisa Skrzicki, the SEC Ombuds, and her wonderful panel. So Lisa, thanks for joining us. The floor is yours.
Thank you, Adam, and thank you, Christina, and thank you, Commissioner Peirce, for those lovely remarks earlier. As Adam noted, my name is Lisa Skrzicki. I'm the acting Ombuds in the Office of the Investor Advocate, and I'm so pleased to introduce the first group today, University of Pittsburgh, Howard University, Seton Hall, and Fordham, as they discuss new investors. The first group we are speaking today is the University of Pittsburgh School of Law, discussing metaverse, AI, and influencers. Sorry. The first group today will be the University of Pittsburgh School of Law, discussing metaverse, AI, and influencers. The students presenting today will be Amit Levine, Trina Patel, Nicholas Bridges, and Carly Kester. Thank you.
Thank you, Lisa, for the introduction. We're going to be discussing a new generation of investors and some of the challenges that they face. Just to give a quick overview of what we'll be discussing, we'll start with talking about the rise of new investors, specifically Gen Z. This will include some of the characteristics of these new investors and their technological abilities and tendencies. We'll then discuss AI in investing, the types of AI and the pros and cons to its use in the investing world. We'll then discuss the metaverse, what it is, the investment opportunities that it holds, and the risks that also come with it. And finally, we'll discuss influencers and their role in investing. This will include an overview of what influencers are and their influence on investing behavior, specifically to Gen Z.
Thank you, Carly. The rise of the new investors. For decades, the face of investing was a suited-up advisor on Wall Street. But today, the average investor is younger, more diverse, and armed with a smartphone. In the study Gen Z and Investing, the FINRA Education Foundation found that 56% of Gen Z, ages 18 to 25, own some sort of investment. So looking at traits and investing trends. Gen Z as an age group have the following characteristics. For starters, they're digital natives. They grew up with the internet, smartphones, and social media and are thus more comfortable with switching to application services rather than face-to-face relationships. This generation is also value-driven. They want their money and investments to align with their beliefs, whether that's climate, equity, diversity, or any other such initiatives. Gen Z is also community-oriented and community-trusting. They're comfortable making decisions based on group trends, social pressure, or even viral tweets and social media posts. This generation also has an entrepreneurial mindset. They want to see fast growth and are more likely to invest in high-risk portfolio, such as crypto, NFT, or volatile stocks. Lastly, Gen Z has a short-term outlook. They often invest with smaller amounts and for shorter time horizons. They're more likely to engage in active day trading rather than long-term portfolio building. Moving on to investing trends. For starters, Gen Z is leading the charge towards utilizing online brokerages where there's commission-free trading, fractional shares, and instant access to the markets. Further, this younger generation prioritizes access, community, and innovation over traditional investing norms. Looking at access, investing is no longer seen as a niche activity for the wealthy or the highly educated. It's a form of empowerment available to anyone with a smartphone. Community. Like I mentioned earlier, Gen Z investors don't invest alone. They invest socially. Whether it's following social media creators who explain complex investing concepts or rallying around meme stocks as a form of collective action, investments are much more community driven. Lastly, innovation. Gen Z and millennials are more likely to invest in cryptocurrency, blockchain projects, AI startups, and other innovative yet volatile stocks. The study Gen Z in Investing found that 19% of all Gen Z in the stock market own either crypto or NFTs. Moving on to AI in investing. Like in most other fields, AI has made its way to everyday investing. One example of AI being used is robo-advisors. These are platforms that use software and machine learning to build and manage investment portfolios. They focus mainly on long-term investments. They could be used by both investors as well as advisors. A few examples include Betterment, Wealthfront, and Schwab Intelligent Portfolios. Another example of AI being used in the investing world is predictive analytics. Brokerages and advising firms are increasingly using predictive analytics to forecast market movements, and then they base their investment strategy on those insights. Lastly, algorithmic trading. Here, AI executes trades based on pre-programmed rules and live data. It's similar to robo-advisors, but focuses much more on short-term investments, such as day trading. There are both positives and negatives to AI in the investing world. Starting with the positives, the first advantage is accessibility. AI allows for low-cost automated investing for beginners. Another advantage is the speed and efficiency in trade execution and portfolio management. Lastly, personalization. AI tailors the advice to the individual based on their risk tolerance, age, and income level. Moving on to the cons. For starters, there's the black box, where users don't always understand how the algorithm makes decisions, leaving the investor in the dark. There could also be data bias. If the AI is trained on flawed or even narrow data, results may be skewed and can lead to poor investments. Lastly, there's a risk of over-reliance. Users may stop thinking critically about investments and blindly trust the AI system.
Thanks, Amit. So now we're going to transition to talking about the metaverse. First, it's going to be necessary to understand why the metaverse is important in this space. At the end of the day, this is a brand new frontier that is likely going to be the new internet. The metaverse is where the new generation of investors are going to be, and institutions are going to want to meet them there. While there's no concrete definition for the metaverse, for our purposes, FINRA's characterization is relevant to us. Think of an immersive world that's interactive and it's going to be experienced in new ways through technological developments in hardware and software. So, like I said, what is available in the metaverse? There are multiple financial institutions that are actively experimenting with incorporating new technology into their products, and this includes broker-dealers. Fidelity actually broke the ice in 2022 by introducing the Fidelity Stack in Decentraland, which we'll talk a little bit more about on the next slide. But here are some of the potential uses that institutions are finding. First, data visualization. So this is using new technologies on 3D platforms in the metaverse to create representations of data that can improve consumability and comprehension. So think of making complex data sets more understandable. Virtual trading is an exciting new aspect. FlexTrade, which is a provider of trading tools for financial markets, has actually introduced an augmented reality trading headset. This allows traders to interact with data in a brand new way. Payments, money. Users are spending over $28 billion a year in the metaverse, and we know this number is only going to go up. In the game Roblox, for example, kids use a process known as bookings, where they convert money into Robux using payment processing services, credit cards, And these developments in technology are likely to further the acceleration of e-commerce in this world. We know the number and dollar value of payments in the metaverse is going to grow exponentially. For training, studies have actually found that learning in the metaverse environment makes students 4 times faster to train, 3 times more confident in applying skills, 4 times more emotionally connected to content, and 4 times more focused. Institutions are going to use this type of technology to train their own employees. For education, financial literacy, we know, is an in-demand product, and the metaverse is only opening up new avenues to reach people. As mentioned before, the Fidelity Stack in Decentraland. It's a virtual building that features a multi-level design complete with a lobby, dance floor, and rooftop garden. And in the Invest Quest at the Fidelity Stack, users are challenged to traverse through the building, learning the basics of ETF investing while gathering orbs along the way. For customer solicitation and service, at the end of the day, again, through the metaverse, companies are meeting new and young investors where they are, not to mention instantaneously. Now, we mentioned this while knowing that concerns are a major portion of our presentation today. Some of the major concerns are listed here. When it comes to accessibility and a digital divide, we know that VR hardware, high-speed internet access, and digital literacy are all prerequisites for meaningful participation in this, but these resources are often unavailable to individuals based on certain circumstances. Without adequate non-VR alternatives and investor education initiatives, the financial literacy gap could actually increase. When it comes to regulatory and compliance concerns, the metaverse financial transactions are raising significant questions about jurisdiction and compliance enforcement. With these services operating across multiple jurisdictions, it's unclear how FINRA and the SEC are going to monitor and enforce investor protections. And traditional disclosure methods like written prospectuses may not translate effectively into metaverse platforms. Another big concern is the gamification of investing. Children and young adults are naturally more susceptible to ignore the link between virtual currency and real money to which it's tied. As a child, spending money on gems or V-Bucks lacks the physical exchange that's important for understanding the reality of spending money. There's significant danger in gamifying investing due to new generations' difficulty in separating online and real-world consequences. And finally, the purposeful design, which is tied into gamification, but targeted investing and solicitation tactics in virtual spaces may exert undue influence on certain young retail investors, steering them toward high-risk financial products. Recently, Epic Games, which is the maker of Fortnite, was ordered to pay the FTC $245 million fine for allowing kids to rack up massive charges without parental consent. The lawsuit claimed that Fortnite's counterintuitive, inconsistent, and confusing button configuration led players to incur unwanted charges based on the press of a single button. Products designed to influence the behavior of young new investors do pose significant risks for the securities industry.
Thank you, Nick. Our final topic within the new generation of investors are finfluencers and the role of social media in investing. To get started, who are finfluencers? Finfluencers are individuals who are considered internet personalities that use their social media presence, like on platforms like YouTube and TikTok, to educate and sway their audience into making certain financial decisions. Although they are compensated by social media platforms based on the engagement received per post, some influencers are also compensated by the businesses that they are recommending individuals invest in. They're either compensated through a flat fee by simply endorsing a certain investment vehicle like securities or cryptocurrency, or through commission, where the business provides a link the finfluencer's followers need to click through and invest in for the finfluencer to earn commission. The finfluencer is required to tell their followers within the post when a brand has sponsored the post, but there is a lack of accountability for this requirement. FINRA conducted a review of over 1,000 social media communications related to 15 firms and found 70% were non-compliant. Whether that was failing to disclose that it was a paid promotion or failing to disclose the risk related to the endorsed product. Do individuals actually follow finfluencers and use their advice for their investment decisions? The studies done on this topic seem to lean towards yes. In TIA's 2021 digital engagement survey, 32% of the 1,000 individuals surveyed say they trust social media influencers and celebrities' financial advice. Even more recent and relevant to the new generation of investors, the Charles Schwab 2024 Modern Wealth Survey found that 71% of Gen Zers receive financial information or advice from YouTube or TikTok.
Why does a new generation trust influencers? Some reasons include distrust in traditional financial institutions. The Great Recession instilled this lack of trust among millennials towards banks and investment firms, a value inherited down toward Gen Z. Because influencers are seemingly transparent and have millions of followers that communicate with each other, their trust is earned. Relatability. Influencers are mostly made up of other Gen Z and millennials who can translate complex financial topics into digestible, quick content and understand the topics this new generation is interested in compared to older wealth managers. Consistency. These influencers are able to remain consistent about what they recommend on a timely basis because they have a financial incentive in terms of being paid thousands of dollars per post. A traditional wealth manager does not earn commission at that magnitude, nor is able to remain cognizant of investment trends and give their clients advice on a daily basis. How do these influencers actually affect investment behavior? Here we have some positive and negative effects, starting with the positive. Influencers have increased financial awareness and literacy among the new generation. They are able to simplify complex financial concepts and reach a broad audience, which makes investing more approachable. They also encourage young people to start investing early. Individuals feel that influencers are trustworthy and relatable, and therefore more likely to follow their advice and decide to invest into actually lucrative areas, which in turn promotes other positive financial behavior like budgeting and saving. Now, getting into some negative effects. With any commission-based job, there is a risk that certain influencers will take advantage of growing trends without properly informing their followers. Because they have a large consumer base, investors will blindly follow the herd and invest without doing their own research. This leads to manipulation tactics such as pump and dump schemes. Many influencers lack formal financial education and therefore are likely to spread misinformation. This is exacerbated by the lack of regulatory standards which would oversee the accuracy and reliability of the information they disseminate. Many influencers also endorse high-risk investments that are not aligned with an individual's investor's risk tolerance or financial goals. This lack of personalization could lead to individuals suffering great losses without any way to hold influencers accountable for leading them astray. So are influencers good or bad? The answer is it depends. Many influencers have educated young people on finances and how to properly invest their money, but many others have introduced risks like spreading misinformation and encouraging high-risk investments. We thank the SEC for this opportunity, and we are open to any questions you might have. Thank you.
Thank you so much, Pitt Law. Just one question. We have just about 2 minutes for you to answer. Could you tell us more about what financial institutions are using metaverse technology and in what capacity are they using this technology?
Thank you, Lisa. So there are several financial institutions that are trying to get involved in the metaverse. As Nick had mentioned, there is Fidelity Stacked, which just joined the metaverse in Decentraland. However, there are other institutions, particularly banks. Now, investment firms haven't quite gathered into the metaverse as other than Fidelity Stacked, but several banks have found value in it, particularly for marketing, as it's a great way to try and gain customers, specifically in Gen Z, because these younger investors or individuals are in the metaverse. However, there's also an aspect that banks are using the metaverse to do virtual banking. So the buying, JP Morgan, for example, has bought land in Decentraland, and then Thailand's commercial bank has bought land in the Sandbox. There are also several Asian banks that have purchased land in the metaverse in either Decentraland or the Sandbox. This shows an intention for financial institutions to get involved further in the metaverse, which indicates several concerns, as Nick had mentioned, regarding the metaverse. Thank you.
Well, thank you, Amit, Karina, Nicholas, and Carly. This was a very interesting presentation, and we really thank you for your hard work on this. Next, I'd like to introduce the Howard University School of Law with a presentation on self-directed accounts hosted by Lauren Harrell and Jabulani Mabaya. Thank you, Howard.
Thank you. Good morning. My name is Lauren Harrell, and I am happy to be here today with my co-presenter, Jabu Mabaya. We are student attorneys in the Investor Justice and Education Clinic at the Howard University School of Law. We would like to thank the SEC for hosting the 2025 Advocacy Clinic Summit and for the opportunity to present on this panel today. Our presentation focuses on some of the important issues investors face when using self-directed securities brokerage accounts to trade securities. When investors use self-directed securities accounts, they are trading securities without direct advice or recommendations from brokers and place the trades themselves over the internet. Self-directed investing has proliferated over the past decade with the use of the internet, smartphones, mobile apps by investors. During this time, securities firms have made it easier for investors to open accounts and place their own trades, presumably after conducting their own research. While it is a positive that more people have access to investing to attempt to meet their financial goals, self-directed investing has resulted in problems and financial losses for many investors. This includes the increase in the number of inexperienced and unknowledgeable investors making important investment decisions without assistance and without fully understanding the risk of certain investment products, strategies, and various types of accounts. One such investor has come to our clinic seeking assistance. This investor was an elderly woman who opened a brokerage account at a large, nationally known brokerage firm using the substantial amount of money her retiree husband had saved for many years for their retirement. When she completed the initial application, she had never informed the broker that she or her husband had a high level of investment knowledge and experience. In any event, the broker permitted this investor to open a risky margin and options account. For the next several years, the investor would conduct her own research of primarily low priced, very risky penny stocks, and then made numerous purchases of these stocks on margin. The investor did so without fully understanding the risk of margin trading, especially trading these types of stocks. As you can imagine, the market prices of many of these stocks dropped considerably, resulting in the firm issuing many margin calls and even selling many of her positions at considerable losses in order to cover the margin calls. As a result, the investor lost nearly half of her husband's retirement money that was deposited into the account. During our meetings with the investor, she stated that she never fully understood the terms of the documents that she signed, why the firm was selling her securities, especially some of the securities she wanted to hold, and why she was losing so much money. She also told us that she continued to trade securities because she was trying to win back some of the money she had lost, and the broker continued to let her trade on margin. She also said that she did not understand why the broker would continue to let her trade securities on margin for several years of trading losses and margin calls, after it should have been clear to the firm that she did not know what she was doing. She stated that it appeared that the broker was just trying to make as much money as possible off of her account in substantial margin interest, fees, and in other ways. This case clearly highlights that investors that use self-directed accounts are in need of considerable education and guidance to help investors make informed investing choices and understand the considerable risk of investing in certain securities and using margin loans to do so. One very important FINRA rule that is available for investors with self-directed accounts is Rule 2090, the Know Your Customer rule. This rule states in relevant part that open quote, every member shall use reasonable diligence in regard to the opening and maintenance of every account to know and retain the essential facts concerning every customer, end quote. In the notice proposing this rule, FINRA states that brokers are required to use diligence in regard to both opening customer accounts as well as maintaining customer accounts to know the essential facts concerning the customer. The notice further states that this information is to be used to aid the firm in all aspects of the customer broker relationship, including determining whether to approve the account, whether to extend margin, the extent of margin, and whether the customer has the financial ability to pay for transactions. The notice also states that the broker's obligations arise from the beginning of the customer broker relationship. It is also clear that FINRA intends this obligation continues throughout the entire duration of the customer broker relationship. To satisfy its Rule 2090 obligations, the broker must determine and monitor the essential facts regarding the customer. These include the customer's financial profile, educational background, prior investment experience, investment goals and objectives, risk tolerance, ability to meet financial obligations and pay for trades, and other factors. The rule also requires that the broker obtain and act upon these essential facts at the opening of the account, as well as while the account is maintained with the broker for the entire time the account is open. The rule further states that it does not matter whether the broker recommended the trades. In our investor's case, At the time the account was opened, she informed the broker that she had very limited income or assets and a moderate amount of limited investment knowledge and experience. In the beginning, she only invested a little money in a couple of well known stocks and paid cash. However, for several years, the investor deposited a very large amount of money in the account and began placing numerous trades on margin in a variety of very risky penny stocks. As these stocks dropped in value, she received many margin calls from her broker, which she was typically unable to satisfy by depositing any money or securities. As a result, the broker sold out many of her stocks at losses, some she really wanted to hold to cover the margin debt. Therefore, these numerous margin calls and sellouts involving very risky penny stocks certainly must have made the broker aware that the essential facts concerning the investor had changed considerably. However, the broker never took any appropriate action to stop the investor from trading penny stocks on margin. Instead, the broker allowed her to continue to buy penny stocks on margin for several years, apparently so that the broker could continue to make a large amount of money in margin interest and fees. So, as you can see, this case illustrates some of the risk involved when customers use self directed accounts to trade securities. The positive news is that Rule 2090, as well as other FINRA rules and policies, are still available to the self directed investor to seek a monetary recovery from the broker in arbitration, even if the broker never recommended the securities.
Thank you, Lauren, so much for that introduction and going over part one. We'll now transition into part two, where we'll discuss self-directed accounts used by experienced traders in complex option strategies. So with the rise of self-directed accounts, more complex trading strategies such as advanced option trades are now accessible to the general public. While many of these investors may have experience and a deep understanding than the average retail investor, it's crucial that their investment goals and financial capabilities are properly evaluated and protected. One case that our clinic recently settled and illustrates some of the challenges faced by experienced option trade traders using self-directed accounts. Our client, was an investor with significant experience using very complex option strategies in his self-directed accounts. In this case, the investor executed a bull call spread option trade, which consisted of buying a call option and simultaneously selling a call option on the same stock with the same exercise date with a different strike price. His hope was to realize a profit if both calls closed in the money, and then his account would be credited with the differences in the strike prices of the call options. In fact, on the exercise date, his bull call spread option was in the money, and it appeared that it would make a profit. However, with just 20 minutes left in the trading day, his brokerage firm canceled the options for no justifiable reason. The broker claimed that there was a risk that his bull call spread trade would not close in the money when the market closed. However, after conducting discovery, after many days of settlement and negotiation, the broker finally agreed to settle and reimburse the client for nearly all of his profits. While we understand that the brokerages are trying to mitigate risk, especially with complex products like options, this case raised two red flags. During our discovery process, we found to determine that the client had a second account with the broker in which he placed an identical bull call spread trade as he did in the first account. Yet the broker did not cancel the trade in the second account and let it expire at a profit to the client. The broker could never provide a reason for its differences in the treatment of the two trades. And second, we also discovered that the broker firm had an internal policy that allowed investors up to 90 minutes after market close to cancel option transactions. So even if the market had moved unfavorably, our client would have still had time to cancel his bull call spread trade and eliminate any financial risk to himself or the broker. This case is another example of the need for considerable investor education and the disclosure by brokers, even when the customer is a very experienced trader using self-directed accounts. FINRA, has several rules that are very helpful for self-directed investors. FINRA Rule 2360 requires that firms conduct due diligence before approving a customer for an option trade, before giving them option trading, and regardless of whether the account is self-directed or the options are recommended. Firms Firms must evaluate essential factors such as customers' investment experience, financial situations, and objectives. They must also provide customers with a standardized option disclosure document outlining the risk involved. In our client's case, he had been approved for option trading under FINRA Rule 2360, and the firm had access to the necessary information to assess his risk profile. However, the firm apparently still unilaterally canceled its profitable bull call spread trade options trade without even following its own internal policies of providing the investor with an extra 90 minutes to cancel the trade if necessary. So at this moment, we will be delighted to answer any questions that may be available. So.
Thank you, Lauren, and thank you, Jabu. This was a really interesting presentation, and thank you so much for bringing these matters to our attention. It's definitely important for us to keep this in mind. Are there any other risks that we should pay attention to as more people move towards self-directed accounts?
Yes, thank you for this question. Another risk of self-directed investors is the use of mobile apps to trade securities. In 2023, FINRA published a guidance in response to an investigation that revealed that brokerage firm mobile apps were not always providing complete and accurate information to investors. FINRA found that often these mobile apps provided false or misleading information about account balances, margin capabilities, margin calls, risk with certain transaction types, and promotions. FINRA made it clear that these problems are unacceptable for self-directed accounts, just like they're unacceptable for accounts managed by brokers and investment advisors.
Thank you. And in cases involving self-directed accounts, what responsibilities do brokerage firms have under FINRA Rule 2360 when approving and managing complex options trades? And could you tell us how a firm's failure to follow its own internal policies may affect investor protection?
Perfect. Under the rule FINRA 2360, brokerage firms are required to evaluate some of those key factors that we discussed earlier in our client situation, which dealt with the customer's investment experience, their financial status, trading objectives, and before approving any account or option trading, even if it's a self-directed account, firms must provide that option disclosure document, which will help to ensure the investor can understand any risk. And then I think it also it doesn't the responsibility doesn't end with just that approval. The firms must want to manage those fairly and consistently, as we saw in the previous situation, where you want to make sure that they are protected from any liability or result of financial harm.
Well, Howard, I want to thank you so much for presenting here today. This was a really interesting presentation, and we thank you so much for the work you do on behalf of investors. Next, I'm pleased to present the students from Seton Hall Law School with their presentation, New Wine in Old Wineskins, Modulating the Modalities of Investor Education. We have Daria Beshanseva, Timothy O'Connor, and Emma Valiente.
You know, Emma, it looks like you're muted. If you don't mind unmuting yourself.
Apologies about that. I think I have to reshare. Okay, apologies about that. My name is Emma Valiente, and I am one of Seton Hall student advocates, and today we're presenting on New Wine and Old Wineskins, Modulating the Modalities of Investor Education. Today you will hear from three of us, myself, Timothy O'Connor, and Dasha Beshanseva. First of all, Seton Hall wanted to provide a bit of an introduction on our investor education roadshows. So Seton Hall delivers financial literacy presentations throughout all of New Jersey's 21 counties. This year, we are set to present 55 roadshows among our 9 student advocates. We present all the way in the tip in Sussex County down to Cape May. We have very diverse audiences that include high school students in New Jersey. High school students are required to have a financial literacy course, and this provides a perfect opportunity for our program to present to them. Further, we present to universities. This year, we've presented to Seton Hall's undergraduate university as well as Montclair State University. We have presented to public libraries across the counties and any other local organization that might be in need of hearing investor advice, which is essentially everyone. Our attendees reflect a broad spectrum of ages, ranging as young as elementary school students, where we play financial literacy games with them to allow them to understand the topic easier, all the way up to residents in senior living facilities who are often susceptible to investor fraud scams. Over the years, the IAP Investor Advocacy Program was founded through a one-time grant from FINRA's Investor Education Foundation in 2011. A lot has changed from 2011 to 2025. 2011, pre-COVID, there was no Zoom or WebEx, and there was a lot of different ways that people were paying attention and showing up in person. Today, a lot of the attention span has gone down, especially among younger audiences. So, how do we successfully make an impact in our roadshows? For one example, we use stock games to diversify investments to hook in the students. We use things called seat and bucks and allow students to choose different real life stock options and explain the impacts of diversifying your investments based on the product. We use worksheets that coincide with the presentations. If people are not willing to attend in person, we accommodate with virtual presentations, and this really helps with increased interaction with our audiences. Today, we are going to talk about a changing demographic in investors and why these roadshows are so important to accommodate this changing demographic. In the last decade, the number of investors under 40 has tripled. According to a 2024 FINRA survey, approximately 21% of investors began investing in 2019. This indicates a substantial increase in younger investors. Two reasons have been flagged why this might be so. In March 2020, the stock market was one of the most volatile months due to the pandemic disruption of the economy. Further, also because of the pandemic, stimulus checks in 2021 fueled a lot of investments. Generation Z, typically described as people born from 1997 to 2012, is more focused on seeing returns from investment than any other generation. And over 50% of investors under the age of 35 have invested in cryptocurrencies, reflecting a growing interest in digital assets. A lot of the younger generations also use apps like Robinhood and other similar day trading devices that allow younger people to be investing much easier. So this sets up a changing demographic. Next, we're going to discuss the challenges and the surprises that come from this demographic, and I'll turn the presentation over to my colleague, Dasha Beshinseva.
Thank you, Emma. Recent studies reveal that Gen Z is rewriting traditional investing norms. Unlike previous generations, they're starting their investment journeys remarkably early. For example, 30% of Gen Z began investing in early adulthood, compared to just 9% of Gen X and even lesser percent, 6% of baby boomers. By the time they enter workforce, 86% of Gen Z have learned about personal investing, showcasing a generational shift in financial literacy and habits. Given that Gen Z is starting to invest earlier, we can expect them to gain a greater familiarity with the market due to their increased exposure. This has important implications for how they might invest as they get older. As more experienced and sophisticated investors, they may demand more sophisticated trading instruments. For example, through the roadshows that we've done, we have seen that younger investors tend to rely on social media for investment advice, which then leads to them being willing to invest without financial literacy, which in turn leads to impulsive decisions and then to high riskier behavior. Further, for example, we already see retail investors branching into trading derivatives such as futures and options, with even popular online e-brokers such as Robinhood making such instruments available. While futures and options once seemed exotic, they are becoming more mainstream. The question is, when Gen Z reaches late 30s, early 40s, what will seem like a plain vanilla trading strategy for them? Through the roadshows, and as I mentioned before, it seems that younger people are having more money soon. So, for example, name, image, and NCAA name, image, and likeness deals for college athletes. A lot of high school students who are about to go out to college. They have those types of deals, which then means that they have more money younger that they would like to invest. Same thing goes for TikTok and Instagram endorsements. Given the fact that younger people get a lot of their trading advice from social media and how young people have more influence over each other, this could prove to be very problematic, and we see lessons from that from meme stocks, where a stock could blow up overnight by just being posted on Twitter and thus cause great instability for the market. The growing conservatism among young investors poses unique challenges for regulators and investor rights advocates. It underscores the need for tailored financial education programs that address their concerns about risk while empowering them to make their informed decisions. I would then like to turn over the presentation to my colleague Timothy O'Connor. Thank you. Tim, I believe you're muted.
Can you hear me now?
Yes, we can hear you.
Okay, thank you. So sorry about that. So building off what Emma and Dasha were talking about, during our road shows, we want to make sure that these young investors are really seeing the challenges that they face, given their shifting priorities and perceptions on really what investing can do for them. So first, we really want them to assure them that a little goes a long way, and it's never too late to start. We know that it can seem very overwhelming to start saving up for a car or a house or even retirement when you start from basically scratch. However, for these young investors, really what they should know is time is their best asset, right? Because it's never too late to start. It's never too late to kind of get into the game of investing to make sure you're building up for your future. So the younger you start, the better. And additionally, we really want these young investors to know the very basic principle that their money can work for them. And really, we see that through different sorts of compound interest and making sure that that money is, while you're being smart with it, is working for you. I usually share during our road shows that I have a retirement account from my life before law school, which I haven't put any money in the last 3 years. However, it has still increased in its value, even though I haven't touched it in the last 3 years, simply because this is a traditional, safe, and smart way to invest your money. And further, while young investors see these get rich quick schemes as kind of like the way and the answer and the way that they should be investing, we need them to know that they must assess the risk. And that is because not all investment vehicles are created equal. And while high reward is the thing that usually stands out to these young investors, higher risk must also be something that they know is associated with those potential high rewards. These include those meme stocks and crypto that my colleague Dasha mentioned before, and how the younger generations we see them flock to those in mass. And really, what we want them to know is if it seems too good to be true, it probably is, especially if you're getting your source from these investments and your advice here mostly from social media. So we really encourage a healthy dose of skepticism in doing anything that you see on social media or anything that's kind of the new attractive results. And while the traditional investing products like stocks and bonds, don't excite the mind the same way and yield these results, they are important for establishing that stability in your portfolio. And so having a stable portfolio helps you build up money to then make different sorts of investments like different private assets or real estate that can be safer down the road, but there's a higher barrier to entry, and having a safe, stable portfolio early on can help you. And further, as founding father Benjamin Franklin said, a failure to plan is a plan to fail. While he was not talking about personal investing, we feel that this is universally helpful advice for these young investors we speak to during our road shows. Really, the main point we want them to take away is that they need to create a plan and remain faithful to it. As Emma mentioned, we will work with them during our road shows and hand out worksheets to really make sure they're assessing their financial situation and then building a plan and sticking with them. And because advice is not applicable to each investor, and each investor has his own or her own plan, we want to make sure that they have these broad principles. So somebody who's recently graduated from undergrad might not have the same advice or same goals that somebody who's entering law school next year. Because as we know, somebody who's entering law school next year might have to worry about different loans and different sorts of expenses. So we want to make sure they're mapping out their kind of financial situation, creating a budget, and starting to save. Thank you. And I believe we have time for questions if there are any.
Thank you, Tim, and thank you, Emma, and thank you, Dasha. This was a fantastic presentation. We have one question. During your roadshows, is there a question that young investors frequently ask you?
Thank you, Lisa. Yes, they really, after we tell them about how to make kind of their plan, they want to know what's our first step. And as we mentioned, not everybody's going to have the first step. So what we tell them to do really is to begin their research and really have that goal they have in mind and kind of plan around that. We want to make sure that, as we mentioned, they're evaluating the kind of the risks and the yields and know that there's going to be some give and take on either of those, and to remain healthy in their balance of those, and really to make sure, as we mentioned, it was mentioned in the opening remarks, that they're maintaining a healthy skepticism and remaining money smart in these investments.
Well, thank you so much, Seton Hall. Dasha, Tim, and Emma, this was a fantastic presentation, and we really thank you and all the work you do on behalf of investors. Finally, I'm pleased to introduce Fordham University, the fourth school in our first panel, and they're going to talk about the lessons they've learned from their cases. Presenting are Garrett Altman, Caitlin Louisi, Erin Lee, Jalen Wright, and Elliot Lamb. Thank you, Fordham.
Thank you, Lisa. Good morning, all. We are legal interns with the Fordham Law Clinic. Our clients seek representation due to their broker's misconduct and disregard for their investment objectives. Through our presentation, we hope to shed greater light on the difficulties that low-income investors face. In our work, we've noticed common themes about the types of clients we serve and the experiences they encounter. Through a discussion of our cases, we want to share some of those themes, including those that may receive less regulatory attention.
So one common theme that we've seen is broker-dealers themselves becoming an impediment to suing, regardless of their underlying claims. We've had instances where a firm has admitted wrongdoing or very clearly made a mistake. Yet prior to us getting involved, they decline to reimburse our clients, offer them insultingly low settlements, or tell them not to bother bringing a claim. For example, we had a churning case, and we learned through discovery that the large broker-dealer's compliance department has already determined that the account had been churned. Despite this acknowledgement, the firm offered our client only 5% of his losses before he was represented by us. The same issue has arisen when our other clients contact customer service. Customer service has given our clients incorrect or misleading information to dissuade them from bringing a claim, while also declining to adequately remedy the situation. These are serious impediments which would leave unrepresented customers feeling powerless to recover their money.
Another problem our clients face is when securities are transferred between FINRA member firms when our clients' brokers switch firms. Some receiving firms do not believe they need to assess the transferred securities for suitability when the brokers control the account. This means that certain firms may accept securities that are clearly unsuitable for customers. As a result, customers remain in unsuitable investments for longer.
Additionally, brokers invest our clients' retirement funds into confusing and complicated investments. Brokers also choose, often, a single risky investment, be it a small microcap stock or an illiquid REIT, and insist to our client that such single investment is appropriate for their financial goals. The common thread here is that in our cases, brokers often advise our client, or even worse, act on their behalf, to take extremely risky positions with their portfolio and then attempt to escape accountability by hiding behind the complex nature of such investments due to our clients' trust.
Another common issue that our clients face is when brokers make misrepresentations and/or omissions about the investment or even the nature of the broker's relationship with the client. Many of our clients invest their entire life savings, And when brokers mislead them to make unsuitable investments, and those investments then lose value, our clients end up losing a significant portion of their savings. And our clients often don't realize that the broker has acted improperly until well after they've lost the money.
Finally, one scenario the clinic sees frequently is when the broker-dealer goes out of business before our clients are able to recoup any of their losses. In other industries, consumers may benefit from a guarantee fund, such as the New York State's Life and Health Insurance Guarantee Fund system that provides recourse for consumers when life or health insurance companies go out of business. For our clients, they do not have those guarantee funds and face significant obstacles when broker-dealers are insolvent. Through our case studies, we will discuss how these themes manifest in practice.
In this first case, our client, a single retired woman with limited investment experience, sought out a broker to help create a financial plan. The broker recommended that our client buy into a long-term care policy and open an investment account. The broker then misled our client into believing that the gains from her investments would be enough to cover the policy premiums, even though the investments the broker recommended didn't have guaranteed returns. But the broker never explained that those premiums could increase. Our client told her broker that she wanted a conservative investment, specifically 90% in bonds and 10% in equities. Instead, the broker invested her in the opposite allocation without our client's knowledge. The broker invested our client in 80% equities and 20% bonds for nearly a year. The broker finally realized the mistake and sold the assets from the aggressive fund. The broker then reinvested our client's funds into the correct allocation of 80% bonds and 20% equities. However, the broker never informed our client that she was invested in the wrong asset allocation for a year. And because of the broker's mistake, our client lost money because stocks were performing worse than bonds during that period. And because our client assumed that the broker invested her conservatively, she didn't review her statements every month. Our client eventually discovered that her broker made the wrong investment and that she lost a significant amount of money. And when she confronted the broker admitted their mistake but refused to reimburse our client for her losses. And when our client made a formal complaint, she was only offered a 7% reimbursement of her actual losses. Once our clinic got involved, the broker-dealer still wouldn't agree to fully reimburse our client. But after we sent the broker-dealer a 20-plus page statement of claim and engaged in multiple rounds of negotiations, the broker-dealer agreed to settle the case and fully reimburse our clients.
We have another case where a retiree with almost no investment experience told a broker that she wanted to open an account and invest her life savings in conservative investments like treasury bonds. The broker talked her out of investing in bonds and told her that his firm, a large broker-dealer, recommended stocks, and she reluctantly agreed. Despite being listed as a conservative investor by the firm, she was put in a risky portfolio made entirely of equities that quickly lost over 10% of her entire life savings in just 2 months. She wasn't truly sure what to make of the situation until a relative, a more experienced investor, looked at her investments and told her that her portfolio was not suitable. The relative got involved and talked to the broker, who told him it was impossible to get the money out of the equities at this time. The broker also admitted that he had not conducted a risk analysis prior to investing her money. Only because the relative persisted in requesting that her investments be sold, were they finally sold. Right before the investments were sold, our client received an email from the broker-dealer that her investment goals had been changed from capital preservation to growth and income, which is what this portfolio appeared more suited for. Our client never had a discussion with the broker to change these goals. It seems clear to us that the broker-dealer recognized that the investments did not match her goals as originally indicated and tried to cover up his mistake. Disturbingly, a customer service representative from the firm then told our client that our client's broker was not actually a broker, but a financial consultant, which meant that they were not liable and there was nothing our client could do to recoup her losses. After we submitted a claim, we got an answer that denied liability and basically blamed our client for not involving her relative sooner.
In another case, a broker urged our client, a soon-to-be retired school teacher, to buy a volatile microcap stock. Our client, with her expressed conservative investment goals, was initially surprised by this recommendation, though she placed her trust in the broker and his confidence in the stock. This trust made sense in light of their long-standing relationship. The trade was unauthorized because the broker never disclosed how much he would purchase or what funds he would use to make that purchase. After this recommendation, the broker sold all of the mutual funds in our client's IRA without telling her and exclusively invested the proceeds in that microcap. After his purchases, this microcap stock made up more than half of her total IRA account. Over the next few months, this investment lost approximately 97% of its original value. Because she trusted the broker, she did not review her monthly account statements. And this is something that many unsophisticated investors do in our experience. She later discovered that her account had lost significant value only because she had a relative who was an experienced investor review her statements. After this discovery, the broker called our client and begged her to stay with the firm and to not sue. His colleague even suggested that they would make back all of her money. This was clearly unrealistic. Eventually, she transferred her account, but even after she transferred the funds, the broker continued to call and text our client in an effort to influence her not to sue. He finally stopped only after we called the firm's counsel.
In another case, our client, a reverend and chaplain at a veterans hospital, was referred by a church friend to invest with a broker who also attended their church. She was an inexperienced investor nearing retirement, needing assistance to manage her retirement funds. She trusted her broker because of their shared community in the church. The broker recommended what our client years later found out to be illiquid REITs, claiming investments in real estate would never drop, but failed to disclose the risks and illiquidity of the investments. When the broker changed firms, the second firm accepted the transfer of the illiquid REIT and later argued it was not their responsibility to assess its suitability. The broker moved again to another firm, attempting to transfer the investment to a third firm. This was a well-known, reputable broker-dealer, which correctly refused it, likely due to its unsuitability. We believe, and an expert we consulted with also agrees, when a broker transfers firms, the subsequent firm must conduct a review of the transferred investments when the broker controls the account. The REIT lost approximately 75% of their value when she owned them. The second firm also misled our client. After her accountant informed her that her investment was unsuitable, she contacted the firm. The firm's compliance officer told her that her REIT was still illiquid, which was inaccurate at that point. Our client did not liquidate based on that information. The broker also tried to persuade her not to sue. To make matters worse, the second firm dissolved, making recovering her losses from that firm impossible.
And finally, we have another case where a retired, inexperienced investor expressed that she wanted a similar fixed annuity to a product that she and her husband had been invested in. As a beneficiary of her husband's life insurance, she came into money to invest after her husband passed away. A mutual friend connected her with a new broker. Our client told her broker that she wanted another fixed annuity. He suggested that she cash out her existing fixed annuity and combine it with the funds she had inherited to purchase another annuity, but without telling her. And instead of purchasing a fixed annuity like she wanted, the broker sold her a variable annuity. As she withdrew from her annuity, she did not understand she was withdrawing from her principal and that she incurred fees executing the withdrawals. At one point, she noticed an unexpected $600 rider fee that was not present with her previous fixed annuity. After this discovery, our client called her broker, and he was unable to even explain what a variable annuity was. Subsequently, our client's daughter filed complaints with the SEC and FINRA and then contacted our clinic. The broker who sold her the variable annuity was barred by FINRA for separate allegations, and the broker-dealer also went out of business, making it more challenging to help her. Now, let me briefly turn to the two recommendations we have to discuss today. We hope that a discussion of our cases raises more awareness of how broker-dealers impede our clients' recovery of losses, and some of the ways the SEC or FINRA can further protect investors. The unfair way in which some firms resolve cases where there are clear instances of broker misconduct warrants greater regulatory action. If regulators were to discover instances where registered broker-dealers actively discouraged customers from legally addressing their complaints, the SEC or FINRA should take appropriate action against that broker-dealer. Additionally, there is some room for the SEC or FINRA to clarify the responsibilities of broker-dealers relating to analyzing transferred investments. Some broker-dealers interpret their compliance obligations differently when accounts are transferred to them. Finally, we would like to thank the SEC for hosting this summit.
Great. Well, thank you so much, Lisa, and all of our panelists for our first panel. I'd now like to shift a little bit to hear about something that is one of our core missions. And Stacy, I'm so glad that you were able to join us today. I see you working diligently on behalf of America's entrepreneurs and small business uh, leaders. So why don't I welcome you? So Stacy Bowers is the director of the Office of the Advocate for Small Business Capital Formation here at the SEC, and her team really do a great job being innovative, looking for new and creative ways to advance the mission and really bring opportunities for capital formation to the market. So Stacy, thanks for joining us. The floor is yours.
Great. Thanks, Adam. Good
This
morning.
meeting is being recorded.
Good morning, and I want to thank the Office of the Investor Advocate for inviting me to briefly speak at this amazing clinic summit that they host. As Adam said, my name's Stacy Bowers, and I'm the director of the Office of the Advocate for Small Business Capital Formation. And any views I express today are my own. So much like the Office of the Investor Advocate, our office was also created by Congress, and it is an independent office within the SEC. But before I talk a bit more about what our office does, I want to thank all of you who are at this summit today for the work you do in the clinics assisting investors. As a former law school professor, I understand the commitment it takes to participate in a clinic while you are juggling all of your other law school responsibilities. So I just want to commend each of you for doing that and committing to that. And it's just a great opportunity and a way to get actual experience. So again, thank you for doing what you're doing. So now back to what does our Small Business Advocacy Office do? And hopefully, maybe I can persuade some of you to consider working in this space after you graduate. So our mission is to advocate and be a voice for small businesses and their investors in the small business capital formation space. And for us, small businesses run the gamut from a startup to a public company with up to 250 million in market capitalization. So our office is actually tasked with helping a really large swath of small businesses. And I just like to say that because I know everybody has a different perspective of what is a small business. Our office was formed in 2019, so we like to joke that we ourselves were transitioning out of our startup phase and maybe becoming more of a middle stage growth company, so to speak. So what some of the main ways that we fulfill our statutory mandates, we engage with a lot of small businesses, their founders, and the investors, because we want to hear what's working well, but we also want to know what's not working well as they head on their capital raising journey. And we do that engagement because then we bring their voices back to the commission and Congress, and we share what we're hearing here at the commission with the commissioners, with other divisions, and we share it with Congress as well. We also review proposed rulemakings and proposed legislation when it has to do with small business capital formation. And we're reviewing it because we're looking at it to assess the impact that it will have on small businesses and their investors. Another thing, and I shouldn't make light of this, that our office does every year is we produce an annual report, and it takes an in-depth analysis of the state of small business capital formation. And you can find that annual report on our website, which is sec.gov/OASB. And we also like to joke in our office, it's not your typical government publication. It's done in color, it's got a lot of graphics and charts, and there's a lot of really great data and information in there just about the state of small business capital formation generally. But we look at it not just through the lens of small business founders, but also investors who are investing in small businesses. And lastly, but clearly not least as well, is we create a wealth of educational resources that are designed to help founders, investors, and other third parties who are helping in this capital raising arena. So I'm going to highlight just a little bit of the data from our annual report, and I really do hope you'll go check it out. But small business capital formation, it's vital to the US economy. And again, when I talk about small business capital formation, that includes both founders and investors who invest in those small businesses. Since 2011, 80% of net new jobs have been created by small businesses. And entrepreneurship is a driver of both societal health and wealth in our country, as well as a creator and promoter of innovations. I want to provide just a few more details that might be of interest to all of you as you pursue your legal careers, as I suspect many of you will find yourselves working with small businesses and their investors on their journeys. We know from our annual report research that 77% of small businesses are worried about being able to raise the capital that they need. And it might surprise you to know that 41% of small businesses are just looking for 50,000 K to get started. So they're not looking for a lot of money. And the last data point I will share, because I think it's particularly relevant to all of you, is that only 2% of small businesses take an equity investment. And those equity investments predominantly come from the business founders or owners themselves, about 70% of the time, friends and family, and angel investors. And now, based on, I looked at your agenda before I hopped on, so I thought if it's okay, I'm going to share a few thoughts on careers, legal careers. So I started my career out of law school at the SEC in the Division of Corporation Finance, and I won't share how long ago that was. But I will say that over the decades I've been a lawyer, I have thoroughly enjoyed helping companies get started, raise capital, whether they're raising capital through a private offering or they're raising capital through an initial public offering. And I've also worked with a lot of companies as they go through a merger and acquisition. I've also had the opportunity to work with investors as they consider making equity investments in businesses of all sizes. Most recently, while I was a law professor, I was also of counsel with a small firm, and I worked really closely with founders who were raising capital, and they wanted to make sure they were doing everything correctly. And it was so rewarding to actually be able to help and guide them through the process and watch many of them go on to great success. So I want to encourage all of you to think about this area of law as a potential pathway. I'm a little biased, I recognize that. Or at least get familiar with it, because I think you'll find that a lot of the clients that you work with through your career, they might want to start a small business. They might already have a small business. They might be an investor in a small business, or they might have a small business or an investment that they want to leave to family members. So I think you might be surprised about how often this will crop up as you move through your legal career. And lastly, I just want to encourage all of you to take a gander at the wealth of resources our office has put together for the small business ecosystem. You can find them by going to sec.gov and clicking on, there's a link up in the upper right-hand corner that says small businesses. So if you click on that link, it'll take you to the resources page. I think in particular, I would suggest you check out the Building Block series. It's categorized by life cycle of the business, but there's also a whole section in there that's designed just for small business investors to help those who are investing and including understanding the risks of what they're investing in. And then you can always reach out to our office. The easiest way to reach us is via email, and that's smallbusiness@sec.gov. And that's true whether you just want to reach out individually, or if something comes up in your work with the clinic that you think would be relevant to our office, or something that you think you need additional insight on, we're here to help. And if we can't assist, I promise you we'll do our best to find someone else at the SECU who can help you. But again, I just want to say thank you for having me and have a wonderful summit.
Hey, thanks so much, Stacy. That's actually really timely because, as people do progress through their careers, there's a good chance, especially in the securities law field, that they're going to be exposed to different elements of that securities. Right now, they're really working with investors and investor protection, but as their career matures, a lot of the students who are presenting today, I think, are going to find out that they're working for firms that are trying to raise capital, or they're working on some mergers and acquisitions, or some area where the securities law really comes into play. So, what a perfect transition, Stacey. Thanks for all you do, and thanks for joining us today. Yeah. So now let's transition. I'm really excited. For the next 45 minutes, right before lunch, I realize, I'm sorry, we are going to be talking to three very talented attorneys who are going to just talk through some of their different career developments. And then about halfway through or so, we're really going to pivot and make this an interactive session. We have, like I said, some really dynamic folks with us today. So first is David Marchinkus. He's the counsel to the chairman here at the SEC. He's spent about 12 or 15 years here at the commission, if I remember correctly. He's been a branch chief in the Division of Investment Management, and a lot of really good experience at firms and stuff that he'll tell you about. Sarah Mashevitz is the senior counsel for the Senate Committee on Health, Education, Labor, and Pensions, the HELP Committee. And she used to work at AARP, where I was privileged to know her back then. And so she really brings together a unique mix in the advocacy world as well as on the Hill. Finally, the Honorable John Pittman, the Associate Judge for the Superior Court right here in DC. He recently retired earlier this year, and he's got a really incredible story to share with you and talk in case people are pursuing an appointment at the bench. So, all of you, thank you for joining this panel today. If you don't mind, let's just do a little bit of a round robin. We'll start this off, like I said, very informally today. But let's start with David, and then we'll go to Sarah, and then John. If you could just tell us a little bit about yourself, your experience, and a little bit of the chronology of your career and how you came essentially from being a second, third year law student to where you are today. So, David, over to you.
Hi, I'm Dave Marcinkus. As Adam noted, I'm currently in the chairman's office working for acting chairman Uyeda. My background is asset management. So of the four big federal securities laws, I deal with the Investment Company Act of 1940 and the Investment Advisors Act of 1940. I am a 2007 graduate of GW Law School. I I started my career at Ropes and Gray, an associate in New York. I was there for about 3 years. Then I was in-house at an asset manager, Lazard. Was there for 2 years. Then I was here for I think 9. I joined the commission in 2012, and I've been here since. I had a 2-year break where I went back to private practice, first at a law firm called Proskauer, and then our group got bought, and we went over to Kirkland and Ellis, and now I've been back here. And one thing I just want to impress on you all, because I graduated college in 2003 and took a year off in between. And you guys are not going to remember this, but that was still the trailing edge of the dot-com burst. And I had a really hard time finding a job out of college. I wanted to be a paralegal because I knew, or I thought I wanted to go to law school. And it wasn't that easy. And that was a very humbling experience for me. And um, in hindsight, I think a very, very useful experience, but at the time, pretty humbling. Then after law school, I'm an '07 grad, so I think you guys all know what happened in '08, '09, still before your time, but the great financial crisis. And I can assure you that that was not a very fun time to be starting your legal career with six-figure student loan debt. So I would just encourage you all. There's a lot going on in the world, but don't focus on that. Focus on what you can control, and just keep moving your feet, and good things will happen. And I'm sure we'll get into more of that. But if there's one thing that I would like you to take away is that just keep moving because careers are long and obstacles go away.
Awesome. Thanks. I can't agree more with what David said. For the record, I'm sure you probably can't throw a stone at a group of millennials without hitting folks who want to talk to you about coming up in recession. So I had the same experience, certainly survived it. Hang in there is my best advice to you all. As Adam said, I'm Sarah Mishevich. I am senior counsel here with the Senate Health, Education, Labor, and Pensions Committee. I also am Bernie Sanders' sort of tax and economic lawyer. I do a lot of his work on stable coins and crypto at large, et cetera. So I'm just to kind of give you a flavor of the issues we work on, although the senator is chiefly interested in making sure that everyone who goes to work has an easy and effective way to save for retirement, most preferably through a traditional pension fund. And so there's a lot of overlap between that work and the work that you guys have been considering and working on with the SEC. So just to kind of give you a little bit of a broader lens of what you can do with your degree, whether that's taxes, retirement, it's the DOL, the IRS, Treasury, et cetera. So do you think broad and wide about the options that you have? And then to give you a bit of my chronology, I actually started in the Illinois Senate doing an internship, and it was so much fun that I decided to continue my career in that. I staffed the Pensions and Investment Committee for the Senate President there, worked on pension obligation bonds and appropriations, et cetera. So came out here, did some legislative tracking for a while for a firm that did Fortune 100 and tax policy. So I got to see what the states across the country did in that policy space, which was super interesting. And in fact, and I'm sure we'll talk more about it later, but if you have the opportunity to go to state or local government, I can't say enough good things about that. Not just because now is the time to do state and local government, as some of the jobs in the DC area have been drying up. So it's both practical and really fun and important work. You get so much more put on your plate at a young age, and with the speed is a lot greater as well. So if you like fast-paced environments, I commend to you state and local government work. After that, I went to ARP on and off for 10 years. I did state lobbying for a good bit of time and some federal lobbying as well. I went to law school at night. So if anybody has questions about how to transition from night school into a career on the Hill, et cetera, happy to answer those questions. When I graduated from law school, I went to Groom Law, which is a kind of niche employee benefits firm. They do both sort of health and the retirement side as well. And then transitioned eventually to the Hill, where I am now in a senior counsel role, where I work for Senator Sanders doing his pensions and tax policy. And I will hand it over to John.
All right, thank you. I'm at the end of my career. In fact, it just ended, at least as a practicing lawyer and practicing judge last 2 months ago. I went to college, took a couple of years off between college and law school. It's too late to give you this advice, but I recommend taking some time off between the two. I did a series of odd jobs and, more importantly, played bass in a rock band. I went to law school, I graduated, I took a clerkship here in the District of Columbia for the DC Court of Appeals, which, for those of you who know the DC court system, DC is not a state, but if it was, DC Court of Appeals is the highest court. It's essentially the state Supreme Court. Clerked there for a year, and I joined a DC firm, now a pretty big firm called Kroll and Mooring, and spent almost 22 years there, first as an associate and then as a partner. I joined thinking I would leave and join the government after a couple of years. And I was fortunate in that I got to do some interesting stuff with some really good lawyers. And I stuck around. Some of the advice I'd give you is to not stay in one place too long, because I think I stayed a little too long. And then in 2012, I joined the DC office of the Attorney General, which is our local Attorney General's office. At the time, the Attorney General was appointed, and then during my tenure there, the DC, by referendum, created an elected Attorney General's office. So I served under our first elected Attorney General, Carl Racine. I was a civil litigator my entire practicing career. So at Kroll and Mooring, I did commercial litigation, sort of specializing in big insurance coverage cases. It's just as boring as it sounds. And when I went to DC, I came in initially as a section chief, a manager, overseeing a team of lawyers who are basically the District of Columbia's defense counsel. So tort cases, employment cases, civil rights cases, about half in the Superior Court of the District of Columbia, half across the street in federal court. It was actually a great job. I had a hard job, but a really great job, and got to know a lot of the local judges in that capacity. And then after Carl came in, I became second in command of the civil litigation division, but still oversaw defending the district in court. And then in 2017, I was nominated to the Superior Court bench. I was confirmed in 2018. That's a story into itself. And I started off, as all judges do, in an area where I knew nothing. You come onto the bench practicing in one area. Typically, the district has 5 divisions. It's basically the trial court of general jurisdiction for anything you can think of. So I began my judicial career in the probate and tax division. I moved to the criminal division, where I did misdemeanors for 2 years, mostly during COVID, knowing absolutely nothing about criminal law. And then moved to the family division, where I did domestic relations, and then finally in the civil division before I retired. It's probably the hardest job I've ever had. It is the hardest job I've ever had, and the best job I ever had. If you can manage to get a judgeship, and it depends on where you're looking, it is. I found it an extremely rewarding experience, and I'll stop with that.
Great. Well, thank you all. Appreciate kind of that intro. So first, to the audience, if you have questions for any of our panelists today, please start thinking of them and dropping them into the chat. You can send them to me directly, or you can send them to everyone. And throughout the discussion, we'll go ahead and answer those. But for our 3 panelists today, I know a lot of our students are kind of at that crossroads where they're second, third year, they're starting to think what their career is going to look like. They're starting to make concrete plans even. Can you share a little bit about when you were a second or third year law student, where did you think your career was going to go? And then, having the benefit of hindsight, can you talk a little bit about maybe what you would have done differently now that you're able to look back retroactively and think about things? So, question, and we'll go the same cycle. We'll go David, Sarah, and then John. Where did you think you were going to go, and then what advice would you have if now that you can adjust that a little bit in hindsight?
Well, I didn't have a clue where I was going to go, but '06 was my summer. It was a very heady time. Everything was going up like a rocket, which should have been a clue that things were poised for a crash. But so it was really easy to get interviews and callbacks and all that. And I had no clue what I was getting into. I actually started thinking I wanted to be a litigator, mostly because that's really what law school is designed for. You really don't know what a corporate lawyer does, frankly, as a law student. So I had no clue. And my when I was picking between law firms, and I don't know what things are like now, but my number one decision point, and I still do this to this day. I think, well, maybe not now that I'm this far in, but when you're making decisions earlier in your career, I think the number one thing should be about opening options, not closing them. Because as I said, I'm an asset management lawyer. I do the Investment Company Act of 1940. My first day at Ropes and Gray, I was given an assignment in the Investment Company Act of 1940. I had never heard of that. I had heard of a mutual fund. I didn't know exactly what it was. I had certainly never heard of an ETF. I actually looked in my securities book, and the Investment Company Act is in the index, but that's it. So you don't know what you're going to do unless you do. I mean, some people do. But if you don't, I think when you're starting your career, it should all be about keeping things as open as you reasonably can, because you never know what life is going to throw at you, and you want to be able to make. As I said, I started as a litigator. I quickly figured out I didn't want to be a litigator anymore, and I was able to do that at Ropes. So as you're looking at firms, as you're thinking about options, if you don't know what you want to do, I think that's perfectly fine and natural. But then try to pick options that will give you as much optionality as you can have, so you can see the world and make a choice.
Yeah, I think that's absolutely right. And in fact, I had a similar start about getting thrown into retirement and pensions work. So when I was an intern in the Illinois Senate, they wanted me to do media and campaigns, which I felt was less, I wanted something more policy heavy. And I continued to ask and ask and ask and ask. And finally they got annoyed with me asking so often for more work, and they said, okay, Sarah, you want something, here's the committee nobody wants, you can go do pensions and investments. And it turned out for me to be the love of my life. So you never know, what seems like it's not a great assignment for you up front may turn out to be the assignment of your career. So keeping your options open is really important. So as I mentioned earlier, I was kind of a less traditional student as far as law schools are concerned. I waited quite a bit of time to go back to law school. And so for folks on the phone who are less traditional, maybe you're a little bit older, or maybe you are a night student, I would say sort of the paths that are open to you are all the same, but you have to pursue them in a different way. So I knew kind of what I wanted to do. I was lucky on that sense, but I just didn't know how to get there. I knew I wanted to be on the Hill. I knew I wanted to do retirement policy. I even knew who had the job I wanted, but I couldn't get from here to there. And one of the key ways was to get into law school, which you guys have already done the hard work there. The other is to kind of think of getting jobs in a way that if you guys have legislative experience, you kind of lobby a bill, right? It's the same kind of approach that you kind of be dogged about it, especially in a negative kind of economic environment like we're in right now. My advice to you as well is to realize that like making the ask for, even if it's a cold call ask to someone who has the job you want or can get you into the job you want, and asking for a cup of coffee, asking for advice, it feels weird when you first start doing it, but it is incredibly normal, especially if you're in Washington, D.C. It's just like currency around here. People do it all the time. So my suggestion to you is never be afraid to make that ask. The worst thing that happens is they ignore your email. So nothing lost, nothing gained. So the other thing I'll say to you, to David's point about keeping doors open, one of the things that I'm actually glad I did coming out of law school was go directly into a law firm. Now, I will tell you, I am pro government service all day long. At what federal, state, local, doesn't matter. Absolutely do government service. But if you think you might want to go into a law firm, starting in a law firm probably, at least in my opinion, is easier than making a transition later into going to a law firm. Get that experience up front, get it on your resume, know what that's like, and then make a jump into government. I think it's harder to do it the other way around.
I think when I was a third year, I had a clerkship lined up, and I had planned after that clerkship to return to a mid-sized firm in Manhattan where I'd been a summer associate. This was back in that time, at least at my law school, jobs were pretty easy to come by. I did the traditional on-campus interview, got a lot of flybacks to both DC and New York, decided I want to be in New York. Turned down a couple of bigger firms for a mid-sized firm that I thought I would get more experience being a stand-up litigator. Never figured that out because after my clerkship, I decided to stay in DC. And at that point, this was the first Iraq war and things sort of were uncertain, and it was a lot harder to get a job coming from a clerkship. And I had a law school classmate whose endorsement for Kroll and Mooring was, "It doesn't totally suck." And so he got me an interview, and I went there, um, and really didn't have a plan beyond that other than let's see where this goes. I sort of had this general idea that careers in big law firms as first-year associates, the vast majority are not going to make it to partner. That was true back then, as I'm sure it is true today. Um, and but I also really enjoyed the people I was working with. I would echo Sarah's point. If you want to get law firm experience, it's better to do it first. I think it's easier with that as a background if you want to end up in government. The other thing I would say, and this probably echoes what others have said, you want to learn as much as you can so you're flexible. When I met with the law clerks who preceded me when I was on the Court of Appeals, one of them said to me, this is the last job you'll have with no downside. From this point on, every decision you make will narrow what you can do after that. And that's kind of true. I mean, if you're a civil litigator, you're not going to become a corporate lawyer if you've got many years of civil litigation. The longer you do one thing, the more specialized you become. So sort of starting out, I kind of had no clue. My career was a series of happy accidents. I ended up at a law firm where I enjoyed working. I stayed probably 10 years too long. And one thing I'd caution all of you about is it's easy to get tunnel vision. You start to see this world where you're in a big firm, everybody knows in a big firm, and you don't see a world outside of that. It was really through kind of some personal issues in my life that I left the firm and just looked at my life and said, hey, I don't really want to be here anymore. That I've learned what I can, but I want to do something different, and ended up at the Attorney General's office, which was just a great experience. I can't, if you want to litigate, go to the government. You will actually try cases. You won't in a law firm, or it will be very rare. So I'm sure I'll have more to say later, but those are my views.
Yeah, I had a little bit of a different experience than John in that I wish I had stayed longer in some places because I'm an '07 grad, so however many years that is, and I did ropes, Lazard, government, Proskauer, Kirkland, back to government. That's a lot, and but you have to do it your way. Every one of those things, when I left ropes, people told me I was crazy. When I left Lazard for the government, people told me I was crazy because they didn't understand what I was doing. When I left the government the first time, people told me I was crazy. You have to do what is right for you. I don't think I could have been a partner if I had stayed at ropes initially. I just don't think I had it in me at that time. I'm being be honest. But now, I mean, I was a partner at Kirkland and Ellis. Um, who knows? Maybe I'll be a partner at Ropes and Gray again, or who knows, wherever. I don't think I could have done that if I had done it the way. Don't worry about what anybody else thinks is the way things should be, because careers are long. You only get one spin in this world, and do it the way you want to do it, and don't listen to other people's voices.
It's all really great advice, you guys. I appreciate you sharing. It really brings me back to the conversation we had the other day when we were preparing for today's call, where we started talking a little bit about the best career advice you can give. And so, we'd kind of planned to go over that, but I think it dovetails really nicely with Sarah's comments when she brought up looking across the body of work and getting experience, like specifically on the Hill or in advocacy across a great number of topics. So, Sarah, can I turn to you real quick and ask you to just share a little bit about what that means for somebody who's going into their career, looking across this body, this very vast option of where they want to take their career and the subjects they want to learn, the type of work that they want to do. Can you tell us a little bit about your experience with that and what you think might be helpful for the students?
Yeah. So I think that the number one piece of advice I'd have for anybody is keeping an open attitude, whether that's about topics or about the types of work that you do. So my feeling has always been, even as senior counsel, I am as equally happy to make photocopies when they're needed as I am to, write a brief about an up and coming legal issue. Also, similarly, even now, every single day, things are thrown my way that I don't know anything about. So basically, today, for example, my meeting before this was about community development funds and donor advised funds. And so I have the opportunity to learn something new every day. Although I think it was right. I think it might have been John that said, so your options kind of narrow over time, but keeping a positive attitude and an open attitude has been really important. So for me, that looked like starting off with the Pensions and Investments Committee. So that meant I was learning how pension funds worked, but I was also trying to figure out how the state of Illinois appropriated funds to its public pensions. And I was also at the same time kind of learning what a bond was, right? I didn't know what that was. And so I think going into the room knowing that you are not the only person who has a question is really important. For years, I would go into a room, especially, SEC, ERISA, all those things. It's all acronym soup. And so you're going to walk into a room and you're going to feel so out of your element. It happens to all of us. And over time, what happens is you realize that people tend to talk in those acronyms because they try to set them apart. They try to set themselves apart as smarter or better or, the person that you should be hiring. But in reality, the person who is incredibly valuable is someone who can take what's going on at the SEC and make it understandable for anyone, right? Because when I get the opportunity to talk to Senator Sanders, I get maybe, if I'm lucky, I get 5 minutes of his full attention. He's got a million things going on a day. So I need to take the number one issue in pensions and make it understandable for someone that doesn't have that background. So it's not just issue related. It's also those skills that you're building, and you can do that in any particular area. So I would tell you, having a good idea what issue you want to do is important, but what's more important is being open.
Thanks, Sarah. That leads perfectly into my next question for John. So, John, you talked in our planning session for this call about the need to really, I quoted it as learn to learn new stuff. And so, in addition to specializing, you really also have to become a generalist pretty quickly. Can you expand on that thinking a little bit and what that means for some of the students?
Yeah. So when I started at Crowell and Mooring, there was a department called the General Litigation Department. I don't know that those exist at firms anymore. We basically would litigate anything that came in the door. Um, if you want to be a litigator, it's really important you learn the skills, know the civil rules, learn how to take depositions, learn how to examine witnesses, learn the rules of discovery, because you'll spend a lot of time doing that as a first year, but also um, learn from your colleagues. Um, I think the best advice I got was when I was a summer associate. Senior associate said to a group of us summers, if you can't sit around waiting for your phone to ring. You got to figure out who in this firm does good work that you want to do, and figure out how to learn from them. People will not hand it to you. And in big firms, I looked at some of your bios, some of you are going to big firms in New York and other places. They'll have a training program, but they really don't have the time. You may get a mentor assigned. That may be great. It may not be. You really have to advocate for yourself. You have to always think, what skills do I want to learn? Who do I want to learn with? And it takes time to do that. At the same time, you don't really know what you're doing when you start out. I just know I didn't. I mean, no first year associate knows how to take a deposition or do a number of things. Unfortunately, law is one of those things, particularly litigation, you just have to do it. Uh, but so it'll take some time. Be patient, but look for opportunities to learn new skills.
If I could add just really quickly, I completely agree. And one of the things we were talking about yesterday on our prep call was the fact that the way law firms work is not necessarily intuitive, especially if you've had other jobs, right? If you took a few years off and maybe you worked in an association or you worked for a corporation. Um, in my experience, the way that assignments are handed out is like pretty linear and makes sense, right? Like you're part of a team, your boss gives you assignment, is what it is. My experience in a law firm is I call it panhandling for work, right? It's all about relationships. So some partners love working with associates, others do not. Some aren't great at the mentoring. And so to John's amazing point, you need to figure out how your law firm works, how work is disseminated, and build those relationships. So the more that you can build a relationship with all the partners and find the one that works the way that you work, you're going to be a lot more successful. I also always give new associates the advice that they should, to the extent possible, ask as many questions up front on assignment parameters as you can. So no one told me, for example, hey, to ask a partner, hey, how many hours do you think is appropriate for me to be billing this assignment? I need to know. And then is it okay with you if, it's a 6-hour assignment and on hour 3, I feel like I'm getting nowhere. Can I come back to you? Maybe that's not appropriate for your law firm, but in a lot of our firms and mine, it really was. And they would appreciate you being a good steward of the client's money and time as well. So think about what questions you can ask up front to be better, not only for yourself, but you're a better associate for the law firm as well.
Let me just add to that. For those of you who are going into law firms, um, you will get an assignment, do this. Try and figure out as soon as you can, where does this fit in the bigger picture? Because what partners want from associates is people who can figure stuff out. You need to be reliable, you need to do excellent work, but partners also want associates thinking about their cases. And I would tell junior associates, when you get an assignment in a case, think to yourself, if I had to try this case to a jury tomorrow, what would my closing argument be? Keep that in mind. Whatever you come up with will be wrong, but keep, and it would be for the partner as well, because if when you're starting out a case, things change. But think beyond getting this assignment done and where does this fit? How does this advance the ball? What are we doing here? And talk with a partner about that. If you show interest in the case as opposed to just the assignment, what's next? You'll do a lot better.
100%. And from like the transactional side, which is what I did, I didn't do any litigation. It may feel to you sometimes like you don't, what's the point? What am I doing? I'm just moving paper. But for example, some of the things I did, okay, maybe somebody had an error with the amount of money they remitted to the IRS in terms of, their retirement plan. Taking a step back, what's really happening is you're helping that employer keep their retirement plan open and operating cost efficiently and available for people to save their own money for retirement so that when your mom, your dad, your grandpa is ready to retire, they can live with dignity and independence as they age. And so, kind of taking that big picture approach, not only will that be better for your mental health, but I think it'll be better for you as you progress within the law firm.
Uh, all these conversations about the law firms are really great. And it really reminds me, and I think David brought this up, that there are a lot of things, a lot of rules, unspoken, unwritten rules at firms, large firms, small firms, boutique firms. Let's spend some time talking about what people really need to know, but nobody teaches them. Maybe, David, you can start us off and we can talk a little bit about the financial structure, the partner compensation model, and let's talk a little bit about what folks might need to think about before going into a firm or as they enter in.
So obviously, I agree with everything that has been said. I think this is all great advice. And uh, I guess I'm the most recent at a big firm, dealing with associates and having been at three law firms. Um, I will say that, in my opinion, the way law firms do have personalities and cultures, believe it or not, and in my view is that that culture is largely driven by how the partners get paid. And the structure of the firm. There are firms still to this day that are single tier equity only partnerships. Most law firms, as you may know, have what are called income partners in addition to equity partners. All those things make a difference, and it may not be so easy to figure that out from the outside. I don't know if they still have the vault guide and all that stuff, or whatever boards they have nowadays. Um, don't go crazy. Don't drive yourself insane. You are a first year associate, but just keep in mind that those types of things do affect your experience. I mean, look, if you are fortunate enough to go to Wachtell, 1-to-1 partner to associate, you are going to have a different experience than if you go to a firm that is 20-to-1 partner to associate. Things like that. Just to the extent you can suss them out, at least keep them in the back of your mind because they are relevant to your experience. Again, don't make yourself crazy because you are relatively junior, but especially as you get to second, third, whatever year, you're talking to friends, you're probably going to realize that your experiences are different. And if you're trying to put your finger on why they're different, um, follow the money, let's just say. There's a reason why law firms act differently. There's one thing I wanted to bring up as we were having this conversation about work, and opportunities and how you have to be ready. When you show up to the first day of, I don't know, basketball camp, right? What's the first thing you do? The layups, passing, fundamentals. Your career is like a house. Every project you do is like a brick. You're building a structure. You can't you can't start at the top. You have to start at the bottom. You're going to get some assignments that are going to be just things that have to get done, turning comments, whatever it is. People are testing you. They're looking to see, can I trust you? What is your attention to detail? You have to walk before you can run. You have to crawl before you can walk. So take each assignment, knock it out of the park, and now this is a brick in your structure that you're building. And then one day, if an opportunity comes, you're ready, right? You're already ready. You've built that strong foundation where you can pivot. You can say, oh, I'm curious about this. I'm curious about that. So, be patient and take every assignment for what it is. It is important to your development, even if it's just keeping versions straight. I'm sure all three of us have stories of screwing up versions of documents, and that will at 2 a.m. Every single one of you is going to have this happen to you, and you are going to feel the terror. Um, Chalk it up to a learning experience.
Also,
Yeah,
just
go for it,
as a
Sarah.
side note, we had a partner we would informally call margins, because if your margins were like 1/10 off, he would lose his mind. So, like, one of the small piece of advice I would give you, ask other associates, better yet, ask your paralegals, hey, what do I need to know about formatting, content, etc., for working with this partner? Because it turned out for me, there was like literally a whole bullet list of things to know about certain partners, and you just have to know to ask. So I think that's important. The other piece I'll give you, advice of you, I don't know that it'll be relevant for everybody. If you're going to a big law firm that's established, it's not going anywhere, and you already have that experience, that's wonderful. I went to a boutique firm, right? And so one of the concerns I had, because I was graduating into a recession, much like you guys might be, um, is what's the financial stability of the firm? So, and if you are last in, are you first out, right? So as much as you are comfortable asking, like sussing that out in your interviews, I do think it's worthwhile. Do it in a respectful way. If it doesn't make sense, please don't ask it. But it did actually enlighten me, um, when I asked about my law firm's financials and security. They were more than willing to talk to me about it, which was the culture of the firm I wanted, right? If I got back a wall from them where they said, I'm unwilling to talk about it, we're stable, you don't need to worry about it, that was not what I was interested in. So kind of think through the type of firm that you want to work for, and what questions might be helpful for that.
So let's pivot to another question from the audience. So, can we talk a little bit about how resilience has helped overcome adversity? Obviously, Sarah, you just mentioned graduating into a recession. David, you talked about kind of the trailing .com boom after college. Um, talk to us a little bit about the skills, the mindset needed to overcome adversity.
Boy, I wish I knew. But I, I agree with what John said earlier about taking off time. It's obviously you guys have all done what you've done, but um, I certainly thought that I could tell the people who went straight through and the people who didn't, because there is sort of a natural progression from, look, everybody here is smart. Gold stars in kindergarten, good grades in high school, good grades in college, good grades in law school, and hours in a law firm are just a different form of good grades. So you could go your whole career and basically it's just a continuation of school in a sense, and that's fine. That's perfectly fine. But at least I thought, that year, you graduate college, awards, this, that, the other thing. Nobody cares. Nobody cared, right? When I was looking for jobs in 2003, nobody cared. That was humbling, and I'm glad that it happened because I don't take anything for granted now. And you have to realize part of resilience is realizing you are responsible for yourself. And if you make a decision that you want to do anything, that's up to you. That's your decision. If you want to make a change, um, that's your decision because you have I don't know what the word is, the fortitude to know that I trust myself. Whatever I do, I'm confident that it will work out because I'm not going to give up. So long as you keep moving your legs, you cannot give, you can't lose, right? It might take you a year or 2 or 3 longer than you thought. So what? So what? So don't be afraid of failure. I've never been in court. I've never been on my feet in court. My equivalent of that is public speaking, at events and what have you. I have had speaking events that went terrible. Absolutely hate it. Is going to happen. You're going to go home. Your girlfriend, your wife, whatever, your boyfriend, your mom, your dad, your dog are still going to be there. So have your base, have the things that make you that your foundation. Don't be afraid to fail. And so long as you never give up, you can't lose.
Well, we have 2 or 3 minutes left. Does anybody want to add to that, Sarah or John?
I think I echo that. I'm, what David said about having family, that's important. It's going to be really hard, particularly for those of you who go to law firms, excuse me, to work-life balance is not something I've ever been able to figure out. And I would encourage all of you to try and do it better than I did. It's hard in a law firm where the coin of the realm is billable hours, and the more the better. It's really hard to have an outside life, but if you can, do as much as you can to do that.
Yeah, I agree. I mean, don't let billable hours, don't let the man get you down. Don't let billable hours get you down. I think for me, it felt like there was a constant ticking clock in the back of my head. Like even if we were getting the 4th of July off, I felt like, okay, I still had to make up billing those hours, right? And so like don't fall into that trap as much as you can. And if you are not a person, if you find out that just isn't the life for you, don't be afraid to make a change. David was saying it. I think that my opinion of the legal world, as much as I love it, is that it is a very stodgy, rule-oriented, obviously, career, and so people will winnow you into the same trodden path over and over, but that may not be right for you, and just because people are telling you you need to be on that path does not mean that's the way you need to do it. So, seriously, keep your options open. Realize that the skills that you've been taught in law school are transferable, whether that's to government, whether that's to, some other kind of in-house job that has nothing to do with lawyering. Your skills make you invaluable, and just don't forget that.
Very
Yeah.
good. Well, hey, we've got 3 minutes left. So very briefly, had a question come in. I'm paraphrasing here, but can you just talk about your thoughts on uh, students seeking a position with great mentorship and learning and training opportunities versus low salary versus a high salary position that is maybe already on that specialist track that John started to talk about. So David, Sarah, and then John, we'll close with you and get everybody out here to lunch very soon.
It's impossible to answer that question without knowing the details, but I think you understand the trade-offs there. I think if you know what you want to do it. And the money will come. I mean, all three of us, I'm sure, I could tell you many stories about people who have had very odd paths to partnerships at top law firms. So if you're doing what you love, then do it. If you don't know what you're going to do, then you got to pay those loans. So go get the money. It'd be my advice.
Yeah, I think that's the first cut, right? Like the reality of your situation, if you have loans and you need to pay them back, then you need to do what you need to do. But if you're lucky enough to be in a position where you could make some decisions, I agree. I mean, I think likely all three of us on this call have had to make this choice, right? To go into government, take a cut, go back to the law firm, and people come in and out, right? And a lot of times that is driven by a financial decision. But like for me, I wound up staying with the mentorship and the personal value I felt with taking a lower salary. But maybe for other people, their economic situation is more is in need of taking a higher salary. My only advice to you is like don't judge other people for their decisions and don't let other people's judgment impact you. Just be yourself.
I'm going to have a slightly different answer. I did take the high salary route back then. I think Kroll and Mooring paid a whopping $68,000 a year to first year associates. But I actually had incredibly great mentors early on. I don't know if that's possible, even at Kroll and Mooring today. Back then it was 150 lawyers. Now it's well over 500. But I had incredibly good mentors, which is part of the reason I stayed. So I wouldn't necessarily say taking a law firm job at a higher salary, don't write off mentorship there. It can occur. It's harder, I think, but it can occur. And likewise, some government jobs, you won't necessarily have great bosses and good mentors. So I would sort of look beyond what are the dollars, assume the low dollar one is better mentorship and the high dollar one isn't, but try and figure out, what's available in terms of mentorship at either one.
Great. Well, thank you all for the time today. We appreciate you being here, sharing your expertise. For all of our participants, all of our students, all of our mentors, faculty, we are going to take a break now until 12:30, so about 25 minutes for lunch. And then we'll be back here for remarks from Commissioner Crenshaw, and then a very exciting panel on cyber and emerging technologies. So I look forward to seeing you all back here in about 25 minutes. Thanks, everyone.
Thanks.